You don't need to trade stocks every day to get rich. You just need to understand how mutual funds quietly build millionaires over time. How can ordinary people use mutual funds to create real wealth? And what simple strategies separate long-term investors from those who barely break even? In this video, I'll share the most powerful lessons from how to become a millionaire from mutual funds, including how to pick the right funds, invest consistently, and let compounding do the heavy lifting. Ever felt like investing is too complicated or risky? The truth is, you don't need to be a financial expert. You just need to follow a system that works. By the end, you'll have a clear, actionable plan to start investing smartly in mutual funds and a roadmap to grow your money into $1 million over time. Picture this. It's a crisp Monday morning in New York City. The streets hum with the rhythm of ambition. Somewhere in the financial district, a man named David sips his coffee, glancing at his investment app. His balance reads $1.2 million. 10 years ago, that number was barely $10,000. No lottery tickets, no startup windfalls, no inheritance, just discipline, patience, and a little-known power hidden inside a word most people overlook: mutual funds. David's story isn't a fairy tale. It's a formula, a blueprint that thousands have quietly followed, turning ordinary incomes into extraordinary fortunes. Yet when most people think of becoming a millionaire, they imagine high-risk stock trading, real estate empires, or launching the next big tech company. Rarely do they think of something as boring as mutual funds. But what if I told you that the path to millionaire status isn't about excitement? It's about consistency. Morgan Housel once said, "Wealth is what you don't see." The truth is, real wealth doesn't come from flashy moves or short-term gains. It comes from quietly compounding returns, one decision at a time. That's the essence of mutual fund investing. Slow, steady, and powerful beyond belief. Let's take a step back and understand what mutual funds really are. A mutual fund is simply a pool of money collected from many investors, managed by professionals who invest in a diversified portfolio of stocks, bonds, or other assets. It's like joining a team where each member contributes, and a skilled coach strategizes to win the long game. The brilliance of mutual funds lies in accessibility. You don't need to be rich to start. You become rich by starting. Whether you're investing $50 a month or $5,000, your money gets to work immediately, harnessing the power of diversification and compounding. Over time, those small contributions snowball into serious wealth. But here's the part most people miss. Mutual fund investing isn't about timing the market. It's about time in the market. Consider this. If you invested just $500 every month into a mutual fund that earns an average of 10% per year, in 30 years, you'd have over $1 million. That's the magic of compound interest. Albert Einstein called it the eighth wonder of the world. Those who understand it earn it. Those who don't, pay it. Still, people hesitate. They say, "The market's risky," or "I don't have time to learn investing." Yet the truth is, not investing is the bigger risk. Inflation eats away your savings, opportunities pass by, and the comfort of a savings account quietly costs you future wealth. Let's imagine Sarah, a 25-year-old marketing executive. She decides to invest $300 a month in a diversified mutual fund portfolio. Her friend Mike, skeptical of markets, keeps his money in a bank account. Fast forward 30 years. Sarah's portfolio has grown to nearly $600,000, while Mike's savings have barely crossed $100,000. Same income, same timeline. One simple difference. Sarah made her money work for her, while Mike let his sit idle. That's the difference between financial comfort and financial freedom. Mutual funds aren't glamorous, but they're reliable, disciplined, and designed to grow wealth over time. As we journey through this audiobook, we'll dive into the psychology, strategies, and structures that make mutual funds the backbone of long-term wealth. We'll explore how millionaires think about investing, the mistakes most beginners make, and how you can build a roadmap to your first million without stress, speculation, or sleepless nights. Because here's the truth. The secret to becoming a millionaire isn't luck. It's not insider knowledge. It's not even intelligence. It's consistency. It's making the same smart decision month after month and letting time do the heavy lifting. In the next chapter, we'll uncover the foundation of all investing success, the power of compounding, and how it quietly turns modest investments into massive fortunes. Imagine planting a single apple seed in your backyard. You water it, nurture it, and wait. For the first few years, the growth feels slow, almost invisible. But one day the tree starts bearing fruit. First a few apples, then dozens, then hundreds. Before you know it, that one seed has given you not just fruit, but a forest of opportunity. That's exactly how compounding works. It starts small, then quietly explodes into abundance. Albert Einstein called compound interest the eighth wonder of the world. He said, "He who understands it earns it. He who doesn't pays it." And nowhere is this truer than in the world of mutual funds. Compounding is the simple yet powerful idea that your returns also earn returns over time. It's money working for you, even when you're not paying attention. Let's make this real. Suppose you invest $1,000 in a mutual fund that grows at an average rate of 10% per year. After 1 year, you'll have $1,100. That doesn't seem too exciting. But in year 2, you're no longer earning interest on just $1,000. You're earning interest on $1,100. The growth builds on itself. Fast forward 20 years, and that same $1,000 becomes nearly $6,700. Push it to 30 years and it grows to more than $17,000, all without adding another cent. That's the magic of compounding. But here's where it gets even more powerful. When you add consistency, imagine investing $500 every month for 30 years into a fund that averages 10% annually. That small monthly habit will grow into over $1.1 million. Not because of luck, not because of market timing, but because of time itself. You see, in investing, time is the most powerful ingredient. The earlier you start, the less you need to invest to reach your goal. Let's compare two friends, Emily and Robert. Emily starts investing $500 per month at age 25 and continues until she's 35, just 10 years. Then she stops and never adds another penny. Robert waits until 35 to start and invests $500 every month until he's 65, 30 years of investing. Who ends up with more? Surprisingly, Emily does. Even though she invested for only 10 years, her money had 30 extra years to compound. Robert, despite investing 3 times longer, couldn't catch up. Emily ends up with over $1 million, while Robert has a little under that. The lesson? The earlier you start, the easier the game becomes. Compounding rewards time, not timing. You don't need to predict the next bull market or panic during a downturn. As long as your money stays invested, it keeps working silently, multiplying behind the scenes. The biggest mistake most people make is interrupting compounding, pulling money out too early, chasing quick returns, or reacting emotionally to market noise. Every time you do that, you reset the compounding clock. Think of Warren Buffett, one of the world's richest investors. More than 90% of his wealth came after he turned 50. Why? Because compounding takes time. Buffett started investing as a child and let decades do the heavy lifting. He once said, "Someone's sitting in the shade today because someone planted a tree a long time ago." Mutual funds are tailor-made for compounding because they automatically reinvest your earnings. Dividends, capital gains, interest. They all get folded back into the fund, buying you more units and increasing your future returns. That's how your wealth snowballs without constant effort. Here's another perspective. If you invest $200 a month starting at age 25, earning 10% annually, by 65, you'll have over $1.2 million. Wait until 35, and you'll end up with less than half. Wait until 45, and it drops to just a quarter. The time you delay costs you not thousands, but millions. Compounding doesn't need brilliance or luck. It needs patience. It's the quiet worker that never sleeps, never complains, and never misses a day. Every reinvested dollar becomes an employee in your personal wealth factory. Over time, those employees multiply, creating an army of moneymakers working for you 24/7. But compounding only works if you let it. Too often, investors sabotage themselves by chasing quick wins or selling out in fear. Compounding thrives on calmness, discipline, and consistency. The more you interfere, the weaker it becomes. So if your goal is to become a millionaire, don't focus on how fast you can get there. Focus on how long you can stay invested. The question isn't, how much can I make this year? It's how long can I let my money grow without interruption? The beauty of compounding is that it doesn't demand perfection. It doesn't care about market headlines or your emotions. It rewards one thing: time. And the sooner you give it that, the sooner it starts working its quiet miracle. In the next chapter, we'll talk about something just as powerful: the psychology of investing. Because while compounding is math, staying invested is mindset. You'll learn why mastering your emotions is just as important as mastering your money, and how behavioral discipline separates the rich from the rest. Picture this. It's the start of a new year, and everyone around you is talking about the stock market. Social media is filled with charts, predictions, and people bragging about how much they made on a particular stock or crypto coin. You open your mutual fund app and see your portfolio down by 10%. Your stomach drops. You start thinking, maybe I should sell before it drops further. Then just 3 months later, the market rebounds. Those who stayed invested see their portfolios climb back and even grow higher than before. You, on the other hand, miss the recovery. You didn't lose money because of a bad fund. You lost it because of your emotions. This is the psychological trap that destroys wealth for millions of investors every year. And it's exactly why mastering your mind is the most important part of becoming a millionaire through mutual funds. Money doesn't just test your intelligence, it tests your patience, your discipline, and your ability to stay calm when everyone else is panicking. Behavioral finance, the study of how emotions influence financial decisions, shows that most investors underperform the very funds they invest in. Why? Because they buy high when excited and sell low when scared. Morgan Housel, the author of The Psychology of Money, once said, "Investing is not the study of finance. It's the study of how people behave with money And that's never been more true than in mutual fund investing. Let's take a simple example. Imagine two investors, Sarah and Mike. Sarah invests in a solid, diversified mutual fund and leaves it untouched for 20 years. Mike, however, constantly checks his account, reacting to every piece of news. When markets dip, he sells. When they rise, he jumps back in. After 2 decades, Sarah's money has grown steadily, while Mike's returns are far lower because his emotions cost him thousands in missed opportunities. Investing success isn't about being the smartest person in the room. It's about being the calmest. When markets crash, the calm investor sees a sale. The emotional one sees a disaster. When markets boom, the calm investor stays grounded. The emotional one gets greedy and overinvests at the top. Let's recall March 2020. The world was in chaos. Markets plunged over 30% in weeks. Many panicked and sold their mutual fund investments. But those who stayed put, or even added more, saw their portfolios double or triple in the following years. The difference between the two groups wasn't information, it was emotion. Warren Buffett's timeless advice fits perfectly here. Be fearful when others are greedy, and greedy when others are fearful. That means when everyone's euphoric, it's time to be cautious. And when everyone's terrified, it might be your best opportunity. The hardest part about investing is doing nothing, especially when fear or greed takes over. But successful mutual fund investors understand that the market is a living organism. It breathes, expands, contracts, and grows again. If you try to fight its natural rhythm, you'll always lose. The best investors create rules that protect them from their emotions. Some set automatic investments every month so they don't have to time the market. Others avoid checking their portfolios too often to prevent panic. The goal isn't to be emotionless, it's to design systems that keep your emotions from controlling your decisions. And let's not forget the role of patience. Investing is one of the few areas in life where doing less often produces more. The most profitable years in any portfolio come after years of consistency and reinvestment. The market doesn't reward activity, it rewards endurance. Think of it like growing bamboo. For the first 5 years, it barely grows above the surface. But beneath the ground, it's building roots, strong, deep, and ready to sustain explosive growth. Then in the 6th year, it suddenly shoots up to 90 feet in just 6 weeks. That's how your investments behave when you stay patient through the dull and difficult years. Remember this: your biggest threat as an investor isn't inflation, taxes, or even bad markets. It's your own reaction to them. Master your mind and you master your wealth. In the next chapter, we'll take this understanding a step further. You'll learn how to choose the right mutual funds for your goals, how to match your personality, timeline, and risk tolerance with funds that can turn your calm, consistent investing into unstoppable growth. Imagine walking into a massive buffet, tables filled with every dish imaginable. You're excited but also overwhelmed. What do you pick? Too much variety can make you freeze. That's exactly how many beginners feel when they first explore mutual funds. There are equity funds, debt funds, hybrid funds, index funds, ETFs, growth funds, small cap, mid cap. The list goes on. But here's the secret. Choosing the right mutual fund isn't about finding the best one. It's about finding the right one for you. The first step in choosing the right fund is understanding your goal. Ask yourself, why am I investing? Is it to build wealth for retirement, buy a home, or achieve financial freedom? The answer determines your time horizon, and your time horizon determines your fund type. If your goal is long-term, say 10 years or more, equity mutual funds should be your focus. They invest in stocks, which means they carry risk in the short term, but offer high returns in the long run. History proves this. Over any 15-year period in the U.S. stock market, equity mutual funds have almost always beaten inflation and created real wealth. For medium-term goals, say 3 to 5 years, hybrid or balanced funds can be ideal. They invest partly in stocks for growth and partly in bonds for stability. They give you a smoother ride, less thrilling than pure equity, but far less volatile. And for short-term goals like saving for a vacation or an emergency fund, debt mutual funds or money market funds work best. They focus on safety and liquidity over growth. The key is alignment. Investing in a long-term equity fund for a short-term need is like booking a roller coaster ride when you just wanted a gentle drive. Now, within each category, you have choices. Take equity mutual funds, for example. You can choose from large cap funds, mid cap funds, small cap funds, or even index funds. Large cap funds invest in stable, blue chip companies. Think Apple, Microsoft, or Johnson & Johnson. They're less volatile but offer moderate returns. Mid-cap and small-cap funds target faster-growing companies, meaning higher potential returns, but also higher risks. Index funds, on the other hand, are the quiet performers. They simply track the market, offering solid long-term results with minimal costs. Speaking of costs, one of the most overlooked aspects of choosing mutual funds is the expense ratio. This is the annual fee charged by the fund to manage your money. It may look tiny, say 1% or 1.5%, but over decades it can eat into your returns. That's why many seasoned investors prefer index funds or ETFs, which have lower fees and often outperform actively managed funds in the long run. Let's look at a real-world example. If you invest $100,000 in a mutual fund that grows at 10% annually but charges 1.5% in fees, after 30 years, you'll have about $1.3 million. Now, if you chose a similar fund with just a 0.2% fee, your balance would be around $1.74 million. That's a $440,000 difference, all because of costs. So when choosing a fund, always check what you're paying for. But cost isn't everything. The fund manager's track record matters too. Look for consistency, funds that have performed well across multiple market cycles, not just during bull runs. Review how the fund performed during downturns. A good fund doesn't avoid losses. It manages them better than others. Another golden rule is diversification. Don't put all your money into one fund or one type of fund. Spread it across different asset classes, sectors, and fund houses. That way, if one underperforms, the others balance it out. Diversification isn't about having many funds. It's about having the right mix of them. Too many funds can dilute your returns and complicate tracking. Usually, 4 to 6 carefully chosen funds are enough for most investors. And then, there's the emotional factor. Choose funds that fit your personality. If you're someone who can't stomach volatility, don't pick aggressive small-cap funds. If you enjoy watching your investments grow fast and can handle the ups and downs, a mix of mid-cap and equity growth funds might suit you better. Remember, your best investment strategy is the one you can stick with through thick and thin. Technology has made this process easier than ever. Today, you can compare funds, analyze risk ratings, and read expert opinions from platforms like Morningstar, Vanguard, and Fidelity. But the most powerful step is often the simplest: start. Because no matter how perfect your plan, it won't work until you take action. Choosing the right mutual funds is like building a house. The materials you choose, the funds, must fit the blueprint, your goals, risk, and time horizon. Once that's in place, the foundation of your financial future becomes unshakable. In the next chapter, we'll explore something just as critical: how to automate your path to wealth. You'll learn why setting up systematic investment plans, SIPs, can turn your financial journey from stressful to effortless, and how automation is the secret weapon of self-made millionaires. Picture this. It's a quiet Monday morning. You wake up, grab your coffee, and go about your day. Somewhere in the background, without you lifting a finger, money from your account moves into your mutual funds, automatically. You didn't have to think about it, you didn't have to time the market, and yet your wealth just grew a little more. That right there is the power of automation. Most people think becoming rich means constantly managing investments, watching the markets, and making quick moves. In reality, most millionaires build wealth through consistency, not complexity. Automation turns investing from a chore into a habit, and from a habit into a lifestyle. A systematic investment plan, SIP, is the perfect example of this in the world of mutual funds. It allows you to invest a fixed amount every month into your chosen fund. Over time, you buy more units when the market is low and fewer when it's high, a process called rupee cost averaging, or dollar cost averaging in the US. This helps you avoid emotional investing and ensures you're always in the game, no matter what the market is doing. Let's look at an example. Imagine Emma, a 28-year-old marketing professional from Chicago. She sets up an automatic SIP of $500 every month into a diversified mutual fund portfolio. She doesn't check it daily, doesn't panic when markets drop, and doesn't celebrate excessively when they rise. She just lets her automation do the work. After 20 years, assuming a 10% annual return, Emma's $500 monthly contribution turns into over $380,000. After 30 years, it grows to more than $1 million, and she never once had to time the market. Automation removes one of the biggest barriers to wealth: human emotion. It helps you invest even when your mind is uncertain. When markets fall, fear tells you to stop investing. When they rise, greed tells you to invest more. But automation silences both voices. It keeps you disciplined when your emotions try to lead you astray. Think of automation like a treadmill that runs at a fixed pace. Once you step on, you don't have to think. You just move forward. And every step, every monthly contribution gets you closer to financial freedom. The consistency matters more than the size. Even if you can only invest $100 a month, the habit you build will serve you for life. One of the most powerful features of automation is the time multiplier effect. When your investments are automated, every dollar starts compounding earlier. Each month you skip isn't just a lost $500. It's a lost future of potential growth. Time in the market, not timing the market, is what builds millionaires. Automation also helps you live your life without financial anxiety. Instead of constantly worrying, am I investing enough? Or when should I invest? You create a system that handles it for you. It turns investing into something that happens to you, not something you have to do. Let's take a real-world analogy. Think of how people save for retirement through 401k plans in the US. Every paycheck automatically allocates a portion toward their retirement funds. Most people don't even notice it happening, yet over decades, it builds life-changing wealth. Mutual fund automation works the same way. It takes advantage of consistency, time, and compounding to quietly build your fortune in the background. And here's the best part. Automation doesn't mean losing control. You can still adjust your contributions as your income grows, rebalance your portfolio yearly, or pause if life throws a curveball. The goal isn't rigidity, it's reliability. Automation also protects you from market timing fatigue. Studies show that even professionals can't consistently predict market highs and lows. But investors who automate and stay invested long-term outperform those who try to jump in and out. In fact, a Fidelity study famously found that the best performing accounts were often those of people who forgot they had accounts. That's how powerful long-term automation can be. So if you want to build millionaire-level wealth through mutual funds, take this simple step. Automate your investments. Set it, forget it, and let time and compounding do their silent work. The best investors in the world don't win because they're the smartest. They win because they're consistent. Automation gives you that consistency. It turns discipline into destiny. In the next chapter, we'll talk about how to diversify your mutual fund portfolio like the wealthy do. You'll discover how spreading your investments strategically can protect your wealth, boost your returns, and make your financial future practically bulletproof. Picture your financial future as a castle. The walls are high, the foundation is strong, and no single storm can bring it down. That's what diversification does for your investments. It doesn't just help you grow your wealth, it helps you protect it. In the world of mutual funds, diversification is your fortress. Now, here's a truth that surprises many investors. Wealth isn't built by avoiding risk, it's built by managing it. Every mutual fund, whether equity, debt, or hybrid, carries some level of risk. Markets fluctuate, economies shift, and industries evolve. But when you diversify, you spread your money across different assets, sectors, and geographies so that no single event can destroy your financial foundation. Think of diversification like having multiple engines on a plane. If one fails, the others keep you flying. If all your money is in one type of mutual fund, say small cap growth funds, you're relying on one engine. The flight might be exciting, but it's risky. But when you mix large cap, mid cap, debt, and international funds, you balance growth with safety. Let's take a look at real numbers. Suppose you had invested $100,000 in just technology-focused mutual funds in early 2000. When the dot-com bubble burst, your portfolio could have fallen by 60% or more. But if you had diversified across technology, healthcare, consumer goods, and bonds, your losses would have been far less severe and your recovery faster. Diversification doesn't eliminate losses entirely, but it cushions the blow and gives you staying power. The goal of diversification is to balance three key elements: risk, return, and time. Younger investors with decades ahead of them can afford more risk, more equity exposure. As you age and your financial goals approach, shifting gradually toward debt or balanced funds preserves what you've built. That's why smart investors regularly rebalance their portfolios, tweaking their fund mix to stay aligned with their goals and risk appetite. A well-diversified mutual fund portfolio often includes a mix like this: equity funds for long-term growth, debt or bond funds for stability, international funds to capture global opportunities, Index funds, or ETFs, for low-cost market participation. Let's say you invest 60% in equity funds, 30% in debt, and 10% in international funds. When the stock market dips, your bonds often rise, cushioning your portfolio. When global markets soar, your international funds lift overall returns. It's like having different musical instruments in a symphony. Each one adds harmony, even when a tone shifts. But there's a mistake many investors make: over-diversification. Owning too many mutual funds can be just as bad as owning too few. It dilutes returns and makes tracking performance difficult. You don't need 20 funds to diversify effectively. Usually, 5 to 8 well-chosen funds are enough to give you exposure across asset classes, sectors, and regions. Let's talk psychology for a moment. Diversification doesn't just protect your money, it protects your mind. When one fund performs poorly, another often performs well. That balance keeps your emotions in check and helps you stay invested. Remember, consistency is the secret ingredient of compounding, and diversification is what allows you to stay consistent without fear. Take a page out of how institutional investors, like pension funds and endowments, invest. They never put all their eggs in one basket. The Yale Endowment Fund, one of the most successful institutional investors in history, built its fortune through a diversified mix of stocks, bonds, real estate, and alternative investments. Mutual fund investors can mirror that strategy on a smaller scale. Diversification also helps you navigate the global economy. For instance, when U.S. markets slow down, emerging markets might be booming. When equities face headwinds, bonds often shine. This global balance helps ensure your financial progress remains steady, even when individual markets falter. And here's something most people don't realize. Diversification gives you freedom. You no longer have to obsess over predicting the next winning sector or fund. You can focus on living your life, knowing your portfolio is designed to thrive through ups and downs. Imagine two investors, Ryan and Chloe. Ryan invests all his money in a single aggressive growth fund. Chloe, on the other hand, divides her investments among a few equity, debt, and international mutual funds. When the market crashes, Ryan's portfolio plunges by 40%. Chloe's only dips by 10%, and within a year, she's back in profit. Ryan, however, is too shaken to re-enter the market. Chloe wins not because she took bigger risks, but because she spread them. Diversification is the art of protecting your downside while still capturing the upside. It's not about maximizing returns every year. It's about ensuring you're still in the game when the big opportunities arrive. So when you're building your mutual fund portfolio, remember this: don't chase perfection, chase balance. The goal isn't to predict which fund will do best. It's to make sure you'll be fine no matter which fund does worst. In the next chapter, we'll explore another critical part of your journey: understanding market cycles and timing without timing. You'll learn how to ride through booms and busts like a pro, and how long-term investors use patience and perspective to turn volatility into opportunity. Picture standing on a beach, watching the waves roll in. Some are gentle ripples, others powerful surges that rise and crash with force. If you were to panic every time a wave rose high or retreated sharply, you'd never enjoy the ocean. The stock market, and by extension, your mutual fund investments, works in exactly the same way. Markets move in cycles. They rise, they fall, and they rise again. The key to becoming a millionaire from mutual funds isn't predicting these waves. It's learning how to ride them calmly. Every investor, no matter how experienced, faces the temptation to time the market. It's that little voice saying, sell now before it drops, or buy now before it's too late. But history shows that even the smartest analysts can't consistently predict short-term market moves. The reason? Markets are driven not just by numbers, but by millions of human emotions: fear, greed, hope, and panic, all colliding every second. Warren Buffett summed it up perfectly. The stock market is a device for transferring money from the impatient to the patient. Mutual fund millionaires aren't the ones who jump in and out trying to catch every rally. They're the ones who stay the course through thick and thin. Let's take a look at how this plays out in real life. Between 2000 and 2020, the US stock market experienced three major crashes: the dot-com bubble, the 2008 financial crisis, and the 2020 pandemic crash. Each time, investors panicked and sold off in droves. But those who stayed invested through those downturns saw their portfolios recover and grow to unprecedented levels. A $10,000 investment in an S&P 500 index fund in 2000, left untouched, would have grown to nearly $45,000 by 2020, despite those major market shocks. Here's where mutual funds give you a huge advantage. They're managed by professionals who understand these cycles, and they're designed for long-term investing. The longer you stay invested, the more likely you are to capture the market's natural upward trend. Over any given year, markets might fall. Over any 10 or 15-year period, they almost always rise. Market cycles have distinct phases: boom, peak, decline, and recovery. During booms, optimism runs wild. Everyone feels like a genius. At the peak, greed is at its highest, and investors start taking on too much risk. When decline hits, fear takes over. People sell, swear off investing, and miss the recovery phase that follows. The cycle then starts again. The investors who understand this pattern and refuse to let emotions dictate decisions are the ones who come out ahead. The best way to handle market cycles is not to fight them, but to flow with them. Your systematic investments, your monthly mutual fund contributions, should continue regardless of whether the market is up or down. In fact, downturns are your biggest allies. During market dips, your SIP buys more units at lower prices, setting you up for greater gains when markets recover. Let's take an example. Suppose Alex invests $500 monthly into a mutual fund. In a year when markets are high, he buys fewer units. In a market correction, his $500 buys more. Over years, his average cost per unit balances out. And when the market rises again, those low-cost units multiply his returns. This simple principle, called dollar cost averaging, is how ordinary investors quietly build extraordinary wealth. Trying to time the market often backfires. According to a study by Dalbar, an independent research firm, the average equity mutual fund investor in the US earned about 5% annually over the last 30 years, while the S&P 500 delivered around 10%. The gap wasn't due to fund performance. It was because investors kept jumping in and out at the wrong times. In other words, they didn't lose to the market, they lost to themselves. Long-term investing is less about predicting and more about enduring. If you zoom out far enough, the market looks less like a roller coaster and more like a steady climb. Volatility is just the price you pay for growth. The challenge is to see downturns not as disasters, but as discounts, temporary sales on long-term wealth. Here's a mental trick that successful investors use. When markets crash, they remind themselves that nothing fundamental has changed about the great companies behind their funds. People are still using smartphones, buying groceries, paying rent, and consuming entertainment. Human progress doesn't stop because of short-term panic, and neither should your investing. In moments of fear, remember this: the stock market has fallen 10% or more dozens of times in history, but it has always recovered and then some. Mutual funds are built to capture that long-term growth. Your job is simply to stay on board while the market does its dance. Market cycles test your patience, not your intelligence. The investors who understand this truth eventually find themselves on the right side of history, wealthier, calmer, and wiser. In the next chapter, we'll explore how to analyze and monitor your mutual funds without falling into the trap of constant tinkering. You'll learn how to make smart, data-driven adjustments and recognize when it's time to stay still, or when a change can truly make a difference. Imagine sailing across the ocean. Even if your compass is perfectly aligned at the start, the wind and waves will slowly nudge your ship off course. If you never stop to check your direction, you can end up hundreds of miles away from your destination. The same thing happens with your investments. Even if your mutual fund plan starts strong, changing markets and shifting goals can quietly steer you off track. The solution? Regularly review and rebalance your portfolio. Reviewing doesn't mean staring at your portfolio every morning and panicking over every red number. It means taking a calm, structured look at your investments periodically, say every 6 months or once a year, to see if they still align with your financial goals, time horizon, and risk tolerance. Let's say, for example, you began investing in 2019 with an allocation of 70% equity mutual funds and 30% debt funds. After a few years of strong stock market growth, your portfolio might have shifted to 85% equity and 15% debt without you doing anything. That extra equity exposure now makes your portfolio riskier than you intended. Rebalancing would mean selling some of your equity units and reinvesting in debt funds to bring your mix back to 70 to 30. It may sound counterintuitive. Why sell what's doing well? Because successful investing isn't about chasing performance. It's about maintaining balance. Rebalancing forces you to sell high and buy low. The golden rule of investing that emotions often make impossible. Rebalancing is like adjusting your sails. Markets move, economies shift, and even your personal circumstances change. Maybe you got a promotion, or maybe you're planning for a child's education. These milestones mean your portfolio's purpose evolves, and your investment mix should evolve with it. There are two main approaches to rebalancing: time-based and threshold-based. Time-based rebalancing means reviewing your investments at fixed intervals, say once a year, and restoring your target allocation. Threshold-based rebalancing kicks in when your portfolio drifts beyond a certain limit. For example, if your equity allocation exceeds 75% when your target was 70%, it's time to rebalance. Both methods work as long as you're consistent. The goal is to ensure that no single asset class dominates your portfolio and that your risk level stays comfortable. But rebalancing isn't only about numbers, it's also about your mindset. Many investors panic during market downturns thinking, should I stop my SIPs? Or should I switch to something safer? In reality, the best move during uncertain times is often to stay steady. Your SIPs automatically buy more units when prices drop, setting you up for stronger gains later. So unless your financial situation has dramatically changed, your best response is usually to keep going. Rebalancing also helps you resist emotional extremes. When markets are booming, it's easy to get greedy. When they're falling, it's easy to get scared. Both emotions are enemies of rational decision-making. A disciplined review process gives you structure, ensuring you act with logic, not impulse. Let's take a real-world example. Suppose Priya started investing 15,000 rupees per month across a few mutual funds, 70% equity, 30% debt. After 3 years, her portfolio grew to 7.2 lakh rupees, but now 82% of it is in equity due to a market rally. Instead of letting it drift further, Priya sells a small portion of her equity fund and redirects it into her debt fund. By doing this, she reduces her risk exposure without reducing her returns. She's not reacting to the market, she's managing it. On the flip side, Rohan started around the same time but never rebalanced. When the market corrected in 2022, his portfolio took a bigger hit than he could emotionally handle. He panicked and withdrew his SIPs, locking in his losses. The difference? One investor managed her emotions through structure, the other let the market dictate his decisions. Another important part of reviewing your investments is checking fund performance relative to peers and benchmarks. Every mutual fund is compared to a standard index, like the Nifty 50 or S&P 500. If your fund consistently underperforms its benchmark for several years, it may be time to consider switching. But remember, don't jump ship after a few bad months. True underperformance is measured over time, not during short-term fluctuations. Also, keep an eye on expense ratios, the fees fund houses charge to manage your investments. Even a small difference, say 1% versus 0.5%, can compound into thousands over decades. Always ensure you're getting the right balance between performance and cost. Finally, your reviews should also reflect your evolving life goals. Maybe you're 5 years away from buying a house, or your retirement is now just a decade away. As you approach your goal, gradually shifting from high-risk equity funds to safer debt funds can protect your gains. This process, called glide path rebalancing, ensures that the money you've built doesn't evaporate just when you need it most. Think of your mutual fund portfolio as a living system. It grows, adapts, and requires nurturing. Reviewing and rebalancing is the act of tending to it, pruning what's overgrown, strengthening what's weak, and keeping it healthy for the long run. In the next chapter, we'll dive into behavioral finance, understanding the hidden psychological traps that make even smart investors do dumb things. You'll learn how to outsmart your own biases, control fear and greed, and make decisions like the wealthy do, calmly, confidently, and with clarity. Let's be honest. Most of us think investing success depends on numbers, charts, or strategy. But Morgan Housel, author of The Psychology of Money, reminds us of a deeper truth. Doing well with money has little to do with how smart you are, and a lot to do with how you behave. And nowhere is this truer than in the world of mutual funds. Because in the long run, the biggest threat to your returns isn't the market, it's your own mind. Imagine two investors, Sam and Rachel. Sam reads every market report, checks his portfolio daily, and reacts instantly to news headlines. Rachel, on the other hand, reviews her mutual funds once a year, stays focused on her goals, and ignores the noise. 10 years later, Rachel's wealth is far greater. Not because she's smarter, but because she mastered her emotions. Sam was busy trying to outsmart the market. Rachel learned to outsmart herself. The first psychological trap most investors fall into is short-term thinking. Mutual funds are designed for the long haul, but human brains crave instant gratification. When markets drop, fear kicks in. When markets rise, greed takes over. The temptation to time the market feels irresistible. Yet history shows that missing just a handful of the best performing days can destroy decades of returns. According to JP Morgan's analysis, if you invested $10,000 in the S&P 500 in 2003 and stayed fully invested until 2023, you'd have around $64,000. But if you missed the 10 best days, your returns would shrink to just $29,000. 10 days out of 20 years cut your wealth in half. That's the cost of emotional decision-making. The next trap is herd mentality. We love to follow the crowd because it feels safe. When everyone is talking about a hot mutual fund or a guaranteed strategy, our instinct says, if everyone's doing it, it must be right. But markets don't reward popularity, they reward patience and discipline. By the time a trend becomes mainstream, the smart money has already moved on. Remember Warren Buffett's advice: be fearful when others are greedy, and greedy when others are fearful. Easier said than done. But that's why mastering psychology is more valuable than chasing trends. Then comes loss aversion, the fear of losing money. Psychologists have found that people feel the pain of losses twice as strongly as the pleasure of gains. That's why when your fund drops 10%, it feels catastrophic, even though you didn't actually lose anything until you sell. Rationally, we know markets fluctuate, but emotionally, it's hard to stay calm. The solution is to zoom out. A dip today might look like a disaster, but on a 10-year chart, it's just a tiny blip on a growing curve. The confirmation bias is another silent enemy. Once we make an investment, we start seeking information that confirms our choice and ignore evidence that contradicts it. That's why some investors stay loyal to underperforming funds long after they've lost their edge. The cure is humility, accepting that you can be wrong, that markets evolve, and that changing course is a sign of strength, not weakness. There's also overconfidence bias, especially among investors who have seen some early success. A few years of good returns make them believe they've figured out the market. But as the saying goes, markets can stay irrational longer than you can stay solvent. The best investors don't try to predict, they prepare. They focus on consistency, not brilliance. And then there's the illusion of control. We love to think that by tweaking our SIPs or switching funds, we can somehow control market outcomes. But mutual funds work best when left alone to do their job, compounding quietly over time. The market doesn't reward activity, it rewards patience. To master investor psychology, you must reprogram how you think about money. Instead of seeing volatility as danger, view it as opportunity. Instead of fearing corrections, see them as discounts. Instead of chasing returns, chase good habits, regular investing, reviewing, rebalancing, and resisting panic. The wealthiest investors aren't those who avoid risk. They're those who manage their reactions to it. One of the simplest but most powerful techniques is automation. Automating your SIPs and portfolio contributions removes emotion from the equation. You invest without hesitation, regardless of market mood. Another is to track your goals, not your returns. When you focus on why you're investing, retirement, a house, your child's education, it's easier to stay grounded when markets get rough. Let's bring this to life with a story. During the 2020 pandemic crash, global markets fell over 30% in just weeks. Millions of investors panicked and stopped their SIPs. But those who stayed invested saw their portfolios recover and reach record highs within a year. It wasn't luck, it was behavior. Fear made some sell at the bottom, discipline made others buy more. The difference between panic and patience? A millionaire's mindset. At its core, mutual fund success is 10% strategy and 90% psychology. You don't need to predict tomorrow, you need to endure today, because time, not timing, is what turns modest investments into massive wealth. Think of your money like a tree. You don't pull it out every week to see if it's growing. You water it, protect it, and let nature take its course. That's how wealth grows, with care, consistency, and calm. In the next chapter, we'll bring it all together. We'll look at how to design a millionaire blueprint using mutual funds. A system that combines strategy, discipline, and mindset into a long-term plan for financial freedom. Because the path to becoming a millionaire doesn't start with a market chart, it starts with mastering yourself. You've now learned the foundations of mutual fund investing: compounding, discipline, patience, and psychology. But knowledge without action is like a map without a journey. The final step is transforming all these lessons into a living, breathing system. A millionaire blueprint that can actually take you from where you are today to financial freedom. And yes, it's possible. No matter your income or background, as long as you have time and consistency on your side. Let's start with a simple question. What does being a millionaire mean to you? For some, it's having a 7-figure bank balance. For others, it's about freedom, the ability to wake up without worrying about bills, to choose how you spend your time, to work because you want to, not because you have to. Whatever your version of wealth is, your mutual fund blueprint must serve that vision. Becoming a millionaire from mutual funds isn't about luck or timing. It's about harnessing the quiet power of compounding. Let's put some numbers to it. If you invest just $500 every month in a diversified equity mutual fund that earns an average annual return of 12%, in 25 years, you'll have over $830,000. Increase that to $700 a month, and you'll cross $1 million. That's not fantasy, it's mathematics. The key isn't the amount you start with, it's the discipline to stay consistent even when the market tests your patience. The blueprint begins with automation. Set up SIPs so investing happens without emotion or hesitation. The biggest enemy of wealth is procrastination, the belief that you'll start next month or when things are better. But every month you delay is a month you lose in compounding power. Remember, time in the market beats timing the market. Next, diversify your mutual funds wisely. A strong millionaire portfolio usually blends equity funds for growth, debt funds for stability, and maybe a hybrid or index fund for balance. Within equity, spread across large cap, mid cap, and international funds to capture different growth opportunities. The goal is not to predict which fund will win, but to create a mix that performs in all seasons. Then comes reviewing and rebalancing, your maintenance routine. Every 6 to 12 months, check your progress and adjust if your goals or life circumstances change. You're not trying to chase performance. You're steering your ship toward the same horizon you set on day one. This keeps your risk in check and your confidence high. The third part of your millionaire system is goal mapping. Don't just invest randomly. Attach every SIP to a clear purpose. One SIP for retirement, one for your child's college, one for a dream home. This psychological anchoring turns abstract numbers into emotional motivation. You're not just investing in mutual funds, you're investing in your future story. Fourth, practice financial minimalism. The more complex your strategy, the more mistakes you'll make. You don't need 20 funds or dozens of accounts. Focus on a handful of high-quality funds that you understand and trust. Wealth is built not through complication, but through clarity. Fifth, protect your wealth through insurance and emergency funds. No matter how well your mutual funds perform, a sudden health crisis or job loss can derail everything. A safety net ensures your investments keep growing uninterrupted. Financial independence isn't just about building wealth, it's about keeping it safe. Finally, and perhaps most importantly, cultivate the millionaire mindset. So here we are, the end of your millionaire blueprint. You've learned how mutual funds can quietly, steadily, and powerfully build wealth. But to identify the best mutual funds based on their investment portfolio, their returns, and their plans for the future, you need a basic understanding of the stock market. To get the knowledge about the stock market and start your journey towards Mutual Fund Millionaire, click on the video popping up on the screen.